All right. Well, we've got Tor Steen just joined us, our CEO. So he'll have some. Stay tuned till the end because Tor's got some additional information he's going to sprinkle in for us, folks. So not only will John and I have a chance to go over all the Miami and the Houston details, answer some questions for you maybe along the way. If you have those questions, make sure you post them in the chat. And then Tor has some additional information that you won't get necessarily outside of this. So we appreciate you being here and being present, being engaged as a city funder. We appreciate all of you. It is now 1:04. We are stylishly running just a few minutes late, fashionably late, they say, right? So I think we can get this show on the road. So we'll do some quick introductions for everybody. So I, of course, am Sundance Brennan, head of acquisitions here at Nada. I handle the acquisition portion of our process, meaning my team goes out and engages with homeowners, finds the assets in designated areas that are good investments. And I like to tell everybody the money is made on the buy. So my team is looking for those constant acquisition sources. We want to make sure the pipeline is healthy and always growing and moving in the right direction. I am probably the only Sundance in the industry. I'm easy to track down. If you need me, Sundance@nada.co. Feel free to reach out if you've got questions or if you've got referrals, folks. Just because you're an investor doesn't mean you don't also have homes or friends who have homes. So if you have friends who want access to equity, feel free to send those our way as well. We'll take a good look at them. So that's who I am. John, can you give us the lowdown or the high level, biography for you?
Yeah, sure. Yeah, thanks, Sundance. So I'm co-founder and CEO here at Nada. I've been, working at Nada on creating different innovative financial products for people to access wealth, whether they're a homeowner or such as, I imagine the audience here, you're an investor and you're seeking to do that for almost 6 years now. Prior to that, I spent over a decade in the mortgage industry where I had some great opportunity to work in quality and strategy, and really got a front row seat to the industry and some of the opportunities that existed there, which truly motivated me to come out and work with this amazing group of people to build a company and a platform that could provide new products to address those issues. The bit of who I am and what I'm focused on. Tor, I'll hand the baton.
Certainly. Thanks, John, and great to have everybody here today. Tor Steen, and I'm the most recent addition to the Nada team. I joined as CEO a couple months ago, but I've known John for a little over a year now, and joined the board of directors for Nada in December of 23. So spent 6 months on the board and still am on the board, but was so excited at what the team was doing here. And when they asked me to come on as CEO, I jumped at the opportunity. I have been in the fintech space for over a decade. I was a co-founder and CEO of a company called CrowdStreet that was doing something a little similar to Cityfunds, but doing in the commercial real estate space, basically democratizing access to great alternative real estate that had not been available to everyday individual investors. And so we grew that platform. It's about 4 billion of equity on the platform, about 700 projects, the largest commercial real estate online investment platform. And I have a background in the technology space for the last 20 years. So I love building things, and I love bringing great opportunities to individuals. So I'll stop there and let us kick off Sundance with the agenda.
Yeah. So here's what we're going to go through today, and we will be, keeping the time frame in mind. This is slated for 45 minutes. Generally speaking, our presentation will take about a half an hour, and we've saved some time for Q&A. If you feel so inclined, feel free to drop us Q&A in between, and if it's pertinent right then and there, we'll answer it for you. Otherwise, we'll get to them all by the end of the session here. So NAV overview is first. So we're going to talk about NAV overview, and we're going to talk about Houston section. We're going to talk about Miami in a separate section, and then we're going to give you some market insights there as well. So not just, hey, what are the numbers, but we figure if you're here, if you're spending some time with us, you want to understand, what goes into these numbers. Why are we making acquisitions the way we are? What key factors are we looking for? So we'll give you some insights there as well. And then, of course, I foreshadowed the fact that Tor will have something special there regarding a bonus at the end of the session, and then Q&A. So with no further ado, because time is ticking, let's talk about net asset value. I'll hand it off to John.
Yeah, thanks, Sundance. So fundamentally, when you think about what you're investing in, when you're investing in one of our city funds, the true basis of the investment is the share price or the membership interest. And the way that value is derived is called net asset value. So when you're thinking of net asset value, it is the total market value of the assets that we've acquired minus the liabilities, such as any debt or anything that we're leveraging to acquire these assets. And then it's quite frankly divided by the number of units, the shares that we've sold. What we're going to go through here is really what drives NAV, that share price, by the activities that the team is doing, so Nets and team, in terms of their acquisitions and the performance of the assets that are being held in each fund. The way that you can track NAV is really throughout our platform. We try to integrate this. We're constantly listening to you guys and trying to create better ways to make this very clear. But whether you're on the mobile app that you've downloaded or the web app where you just log into the website, there are pretty prominent charts and information regarding NAV. And again, know that this is really the share price, the value of your investment that you've made into a fund. All right, so NAV update schedules, because we are managing quite a few funds, and we want to make sure everyone has opportunity windows to look at really the activity of these funds and when is there a great opportunity to invest, what's happening here. We've really staggered the time in which we're going to do pricing updates, NAV updates, and when we're going to present them. So today we're in the August presentation where we're talking about what is the performance of our Miami and Houston city funds. Coming up in September, we will be discussing Austin and Denver, and then some additional funds that we have on deck that are still early stage in terms of they are early in raising capital and acquiring assets. And so these will be funds coming up for their first ever pricing updates. And they are LA, Phoenix, Nashville. And in fact, we have a couple of new funds that we'll announce here soon that are not even on there.
Any indication, John, of which one of those three is furthest along, or which one is, likely to go live first?
In terms of pricing and performance, it would be Phoenix. Phoenix, we've made some, you and team made some great acquisitions there that are what you would say in the money. They are valued more than what we spent, and the asset flow is pretty strong there. LA has a great deal of opportunity for us in terms of assets and maturation, but still a little bit longer likely in its cycle from when it will see the first pricing update. And Nashville's on deck by the end of the year to launch as an investable city.
Excellent. We just closed our first LA deal. Well, we scheduled it to close, so the first asset is almost in the books now. So happy about that one. All right, next up here for you, I want to tee you up for fund updates, and then I'll handle some market insights here.
Okay, so this is the big reveal for us. So the team just recently filed with the SEC the upcoming NAV, the share price for both of the funds we're talking about today. So Houston is really our headline. Houston is still a very new fund for us, and this is the first pricing update. So now it is public record that the share price, the NAV for Houston, is going to go from its initial offering of $10 up to $10.51. So that's an over 5% appreciation in share value that's presented to everyone in its first pricing update. Now, where this is most advantageous for anyone listening and considering these markets as an investment is by the way of really filing an update and announcing a new pricing. It is a future date. So the date in which this new price will go into effect is actually on Friday, August 23rd. So what that means is you still have a few days to buy shares in Houston at the current share price of $10. And you now know, because of the assets that it holds, that you're going to be able to realize an over 5% appreciation in less than a week if you do decide to invest in the Houston market. So just drilling down a little bit. So what has Houston done since we brought it to market? Houston became an active fund for us in March of this year. And from March to August, we've acquired 5 different home equity investments or home equity agreements in the greater Houston MSA. And again, for those that maybe have not really double clicked on this and we haven't shared it, the most amazing part of our funds and the structure is really this home equity agreement, these investments that we're placing into owner occupied homes. And because these investments allow a homeowner to sell a fraction of their equity, they get cash today, there's no debt, it's a tremendous value to a homeowner. We're able to structure these agreements and contracts in a way to where when we place an investment, the actual lien that we're securing in that home is of greater value than the cash we're giving the homeowner, because that's in effect the repayment mechanism, as opposed to interest like a debt. And as you can see here, the 5 acquisitions, we spent under $415,000 to fund and acquire these investments, and the actual mark-to-market value of these agreements that we have in place is $487,000. So that's where you see the appreciation in the investments and the assets held that have been made. And then once you were to take out the liabilities that the Houston City Fund has, that's really where you get to what is the net asset value. And that's what's driving that big movement from $10 to $10.51, again, over a 5% appreciation. I'll add that right now, because this is the first pricing update, and we want to really invite everyone new to get in, and anyone may have already participated in Houston to perhaps buy more shares. We've actually added an additional manager funded incentive to where you could get up to over 10% appreciation on your initial investment in Houston. And we'll talk more about this. Tor will share more later on in the presentation on how you can do that. Okay, so again, because we create funds that are really thematic and designed to be representative of these major markets and the residential real estate market, we always like to present how has our fund performance over the same period of time performed relative to the residential real estate home price appreciation market. So when you look at the Houston MSA over the same time period, that is March to August, the actual appreciation rate on homes is 0.47%. So pretty modest. It's been pretty light. Yet the fund, as you know, because of the virtue of our investments and the way that the contracts are structured, we're able to make investments that actually outperform the Houston market. So the fund is up 5.1%, well above that 0.47% that is the Houston residential real estate market. So this is just a consistent way we're presenting how the funds and our investments are performing relative to the housing market in the same.
And that launch date March 7th, right? So it takes a few months for these assets to season in there before we can do that first reprice. Is there any, in the future, let's say those new funds launch, is it, similar timeframes, or is it really just like the number of assets that we have in the particular fund, moving forward before there's reprices, those initial reprice?
Yeah, it's safe for everyone to presume that there is a 4 to 6 month period of a ramp up of a fund. Even if we're carrying assets, we really want to see, how's the operations and liabilities associated with it, and what is the asset pipeline looking like before we were to publish pricing updates. Because once we publish, as you know, Sundance, a net asset value, a price update, we really like to stick with that quarterly consistency and not have a lull in new assets or any meaningful performance. So that's why you really should always consider that that's going to be, again, really a 4 to 6 month ramp up for any new fund. Can be sooner, but that's the proper assumption.
Yeah, we'll set those expectations. Fair enough. All right, market insights here. So what is it that we really like about Houston? Why are we bullish on Houston? We're in Texas. Our HQ is in Dallas. We also have offices in Austin and the Houston area. Like, we passed through there. I was just there recently. I've got kids, and we went down there and we checked out the NASA stuff. Like, Houston area is amazing. One of the things that we look at is infrastructure. When people are relocating to an area, like, what does infrastructure look like? are they prepared for new subdivisions, new population growth? Infrastructure is key to their ability to grow. And Houston, one of those legacy cities that's been around for a long time, they need to invest in infrastructure, and they are currently doing that to make sure that there is ease of access for commuters, for regular, new builds, new construction to be built just on the outskirts of Houston, which are still accessible for us, and brings in additional share opportunities for us. And then let's talk about job creation. So Houston is not just the energy capital really of the country, right? And we're not talking about just natural gas, oil. We're also talking about alternative forms of energy as well. So solar, green energy, wind actually is like there's a whole ecosystem around all types of energy in Houston, and that area is still booming quite a bit and growing. So it's not like there's going to be a smaller population at any point in time in the near future. With energy consumption on the rise, Houston's population and job growth is likely to keep rising as well. Many people in the news have not more than what 18 months ago there was the ice mageddon issues with the power availability in Texas. Well, people are taking action with that in regards to energy, and Houston is where a lot of that action is taking place. So we're watching that activity, watching the job growth, watching what's happening there, and really like realizing, okay, Houston market we think is pumping the primer right now. So the median market price in Houston right now is below the national average, which is unusual for an area that we think is going to see this type of economic growth, this type of employment opportunity growth. And interest rates are still high. They came down just a little bit this last couple of weeks, but there's a lot of renters there, and they've got jobs, they've got good income. Texas, as you may be aware, doesn't have state income tax. Like these folks in Texas are keeping more of their paychecks right now, but they're choosing to rent. And we realize, okay, there's pent up demand right now for new purchases. There's new builds happening right now. They're just not available on the market, but builders are taking action. So once that supply is there, interest rates fall maybe just another, quarter of a percent, 25 bips, something along those lines, we're going to start to see a big movement there. Now, NAR put out some details really this last month that they anticipate the next 12 to 24 months really to be sort of stagnant there. I don't think it's going to be that long personally, but when that interest rate change happens, we think there's going to be a nice pop based on the pent up supply or pent up demand and the ability, the capacity of the people in Houston to make those purchases. So that's what we're bullish on right now. We like the market a lot. We want to make purchases now before you start to see all that uptick. So a lot of part of what we do is, looking into the key factors and making sure that we're making educated decisions. Happy to answer questions on any of that. I love talking about this stuff, but I also want to tee up John so he could talk about Miami. Oh, I lost the screen there for a second.
Yeah, I was doing a refresh, but yeah, great points about market activity. And I'll go back to the duration and snapshot of how we even showed the Houston home price appreciation. Like, what is the movement there? It is a great point in terms of just showing how our fund has performed relative to it, but it can be a bit noisy. You should really always, as we do, you have to look at real estate as an asset over a longer term horizon. And so I would recommend, it's 5, 7, 10 years is really the best way to look at it. And so a lot of what Sunnis is alluding to, the activities we're seeing in Houston, they're going to drive, the market movement there, and even more so. Sunnis, you're going to talk about this a little bit more in a minute, but the use case of the transition to different like energy efficient solutions and ways to be more prepared in times of some type of crisis, whether it's ice or various storms. It's also reasons to motivate you to invest in solar power and different things. And so the way that these customers, these homeowners can use our financial product, which is the asset and fund, is going to continue to sustain and grow in that market. And so it gets a really a strong housing market, but maybe a little bit more nuanced for us, even a more very niche target use case of our investment. We love it when homeowners are using the cash out of their equity to invest in something that is like solar, which is creating more value in the home, more sustainability, and just generally better for everyone. But yeah, all right. So now to Miami. Miami is one of our a little bit more seasoned funds. And we're announcing now that the new NAV's coming out, same time frame here. The share price for Miami will be going to $11.70 on Friday, August 23rd. And you're going to have an opportunity to get into this fund. Over the rolling 12 months, the fund is appreciated on an equity basis of over 17%, or just at 17%. Nice, simple, round number there. What are some of the activities that we've done in the Miami City Fund over the last 3 months? The Miami City Fund has made two new acquisitions, of which we paid $216K for these investments made in Miami, and the actual mark-to-market value of these assets is almost at $269,000. So these are really good assets in terms of the value of them. In some instances, and this will come into play in a later slide too, a city fund may acquire an HEI asset that has been owned by another fund of ours or another warehousing type facility that we're moving into it. So sometimes the appreciation has been built up, and it could be even greater than if it was just originated net new. At the end of the day, you guys as potential investors in these funds are going to realize the benefit of these massive appreciations and value relative to the cost. Perhaps I just always like to reset and assume the audience here kind of needs to get a refreshing of how we go about things. When we talk about arriving at the HEI value, the actual asset value, because we're making these are contracts and security investments in residential homes. So the basis of arriving at the value is not something that is just made up by us. We use third-party property valuations, like automated appraisals, to come up with pricing the actual asset, the single-family residential home, and then using that against our contract to come up with the value of each asset, and then pull that value to arrive at the net asset value. All of this is disclosed within our SEC filings in detail, but just the same, we're very accessible. If anyone has questions they'd like to ask as to how we do that or any additional elements of it. But going into Miami, so Miami is now on a rolling 3-month performance update. And so since the last time we updated pricing, it is currently being sold at $11.51 per share. And there's an opportunity to continue buying shares at that price today before the price is to move up to $11.70 again on August 23rd here this month. So that's a great performance over again a rolling 3-month kind of a quarterly basis for the fund. It's 1.65% appreciation. So once you were to annualize that, it's a really strong appreciation for the fund. And considering this is not a first price update, which is really like with Houston, you're going to see your biggest bump on your first pricing update, and then a more consistent, gradual appreciation. Very strong performance and a great opportunity. Miami's a market that we feel very good about. We're going to talk more about the pipeline we have there too. Okay, as with Houston, we're going to show you how have we performed over, in this case, the last 12 months, because again, Miami's a bit more of a seasoned fund. How has the housing market there performed relative to our fund? The Miami residential real estate market has performed very well. In fact, over the last 7 months, it's up 7.7%. Again, single family residential homes in the greater Miami metro is what that basis is. That's a really strong real estate market, especially relative to current market movements. And you can really see kind of a similar reflection as to how we're generally always floating a bit above what the residential real estate market is. So if you're thinking about getting into Miami, you like what Miami's doing, maybe you like that Messi's playing for their MLS team, and these various factors that could drive value in Miami, increasing value. You can not only participate in that, but you can see how we can actually slightly outperform it because of the type investments we're making in that market. So 7.7% home price appreciation, 17% is the fund appreciation for our Miami City Fund over that same duration. Again, just with a bit more of the our commitment to being transparent and open and really breaking down how do these NAV movements and appreciation and value get calculated, what is the performance of the assets held This is a list of the assets that we've actually realized exits on that have been held in the Miami City Fund. If anyone that is familiar with our app and how we present, because these are owner-occupied homes, we don't directly display the address or direct pins where you know to maintain the privacy of the homeowners. So we give them random names, and that's when you see the villa, the Surfside. Yeah, you can track these in the app. But this is really what take the villa, for example. The homeowner was getting $26,000, so the investment, the acquisition was 26,250, and then we realized a payoff. This individual sold their home, and we received in return $29,566. So that's a 12.6% gain on the exit value relative to the acquisition. And then, if you were to put that to an IRR, that's a 20% IRR on that single asset. And really, this whole table here, if you guys could just kind of take it in for a minute, you can see that the gain on exit for each of these assets is above 10%, and the IRRs are very strong. They're on average in that same target range that we really have set for the funds at around 16 to 18%. There is one note: this bottom asset, the Cove, it's one of these assets that was held in another warehousing facility. So the contract with the homeowner had aged for some time. And by the time we sold it to Miami, it just so happened that it sold off in a very short amount of time. So for 5 days. So a bit of a funny thing, but the reason we're not displaying the IRR here is because if you truly calculated that on an annualized basis, I think it's somewhere around 14 million, could be a bit misleading, but a really great return to a short duration is good for everyone. It just reports a little weird.
Yeah. The last 12 months, now that we've got a little bit of history on not just Miami, all of our funds, but we're talking about Miami today. How are these matured? How has our strategy changed or evolved? And what makes up these 21 assets that we have acquired over the last year? And how do we find some assets that liquidated, exited within a relatively short amount of time as well? So the largest use case really for us has been solar in Miami. We have people there that want to be energy independent and make sure that they have, the power still on if there happens to be strong winds that day or something happens. So being energy independent, and apparently cost of energy in Miami is also relatively high as well. So if any attendees are from the Miami area, perhaps you can verify the cost of energy there is skyrocketing. So solar. And we like solar because after somebody installs solar, the overall property value is increased as well. So that is a bonus for investors as well as the homeowners. That's a win-win scenario. We'd also do some debt consolidations. That's the second most popular use case in Miami. In fact, the Cove that John was just talking about, that particular asset, I'm familiar with that one. That one was a debt consolidation. They did a combination of things. They did some minor home repairs along with some debt consolidation. In times of inflation, somebody wanted to manage their cash flow. And so they wanted to maximize that. And this put that particular homeowner in a much stronger position from a cash flow standpoint. And then last but not least, as I've alluded to already, general home improvement. And sometimes these things there's a combination of activities that happen. Somebody might put in an accessory dwelling unit or convert their garage into an additional unit. Housing is expensive now, and there's opportunities now to make those conversions or add additional living space onto your existing property. And we like that a lot because again, it increases the value. If you add a bedroom that's permitted, your property valuation is going up. So much so in many cases we can't even actually fully reflect that in the automated system. We know it's happening, but we can't track it dollar for dollar. We have to we notate it in the system, and in general that's what's moving in the right direction. But it'll probably be another 4 or 5 months before we see the gain from that, because it has to report to the county level, and then the square footage gets updated and our automated system will catch up to that. So we've got that to look at on the horizon. Now, these initial 21 acquisitions, we still got 16 of them on the books, and we actually have one payoff pending. But the 5 that have exited, in some cases, we knew that they were going to exit. These were cases where somebody was looking to sell their property, but couldn't get top dollar for it based on the condition of the home that it was in right now. So they contacted us, said, hey, I want to add in that extra bedroom so I do get top dollar for my property. Well, that's a win-win for us. Our capital turns over relatively quickly, and we can help out investors. And these funds are still relatively new. We need to make sure that those startup capital costs, to start the fund, we need to outrun those quickly for investors. So we did that strategically as part of the ramp up strategy for this fund and some of the other funds as well. So we're moving in the right direction there. Longer term holds though for home improvement and solar in all likelihood. Generally speaking, if you're improving your house, you're going to live there for a little while. We do have some new deals on the horizon. So we've got 5 deals in the horizon for Miami, and I think three of them are solar deals. One is just a general home improvement, and one is general use cash out. We like again those solar partners are very strong in that area, and we're pretty selective about what deals we do take because we want to make sure we've got the right appreciation built into the deal. But a little over $500,000 in acquisitions available right now in Miami, and you've already seen based on what's happened in Houston, what $500,000 or 5 deals can do to the NAV. So we're looking forward to closing that out. If you're interested in Miami, we've got those assets lined up. So those acquisitions are available, in the pipeline, really just pending, enough, investors to say, yep, we've got all those funds available for you. Otherwise, we've got a full pipeline of all the cities. We didn't really talk about Houston, but we've got a decent amount of files in the pipeline for Houston as well, John. Market insights. So Miami is a unique market. I think you could see from the screen. Generally speaking, we like infrastructure. We like when people are moving to the area. But really, what I want to talk about is the job growth and what's happening in Miami. So Miami and really, Texas as well. So Florida and Texas seem to be battling it out for additional financial institutions, relocating to these two locations. Miami's got a pretty good head start, and there just seems to be a general trend of big money institutions relocating away from places like New York. So they are looking for safe havens, and Miami is one of those locations. So not only is big money coming into Miami, we're talking about Blackstone, Citadel, the Rothschild and Co. I didn't even realize until recently they had relocated a good portion of their operations to Miami. And then we've got Peter Thiel's operation is there now as well. So there's a lot of money that is really kind of getting aggregated in the Miami district. And you know what they say, John? Follow the money. So all of these entrepreneurs, everybody who wants VC money, everybody who needs liquidity, everybody who wants to borrow, like they all want to be near these folks because they want FaceTime with them. So now you're looking at a situation where, okay, all these fintech operations are relocating to Miami. And now, well, you need tech providers to support those fintech operations. So now we've got not just the Wall Street of the South, but now we've got like the new Silicon Valley. So Miami's got all of these sort of moving pieces, plus great weather, 360 days of the year. Apparently, 5 days of the year there, it rains like crazy. But you know what? They've got solar, they've got their power on, they're happy to be there. And home prices are still appreciating, SFRs in particular. They've had issues with condos in the past, and they just can't keep up with the housing demand there. So single family residents in Miami, in the whole like metropolitan statistical area, are, in our opinion, it's a good time to invest in that location. It just continues to grow and continues to deliver for us.
Well said, Sundance. Tori, you want to share this exciting news with everyone?
Yeah, I get to be the exclamation point at the end of the sentence, right? And so, it's exciting because I think on these webinars, number one, we get to talk obviously about the NAV update, which was is just being implemented. But number two, we get to talk about the fund and the performance of the fund. And then third, we have a way to kind of give back, I think, to the investors, right? Because this is from NADA. This is NADA's promotion and ability for us. We are buying these shares on your behalf. So we have a window of time that we can do this. And so this promotion is running through Thursday, August 22nd, right up until Friday when the actual price changes on the NAV. So for those investors that participate in this period of time, they're going to get 5% extra bonus shares on investing 10,000 or more, and they'll earn 33% if their investment into either of these funds is between $1,000 and $10,000. So exciting time. And again, this is not as a way of kind of giving back to you for being an investor. And again, we only get to do these for each fund on a quarterly basis, right? This NAV update happens each quarter. And so same thing with this promo. It coincides with the NAV update. It'll only be running for the next week now. And we're all also available beyond the webinar to provide answers to any of your questions. And I'm sure there's some questions already coming in, but I know we've got investors on the webinar who are already invested in these funds and are excited to hear the updates. We've got investors that are in other city funds that are intrigued by Miami and Houston. And then we've got some individuals on the call here who've never invested with city funds before. So hopefully you found it educational to learn more about how city funds works, and specifically how the NAV update occurs every quarter for each one of the funds. So let me pause there, Sundance and John, and I think we'll roll right into Q&A.
Yeah, I think that's great. I want to hammer home that when the first pricing update occurs on a new fund, it is one of the greatest opportunities to acquire as many shares in the fund as you can at a lower price. And so once you look at the 5% match that we're willing to offer with the cash that we're funding, like Tor said, for Houston, for example, additive to the pricing movement going 5%, that's an opportunity to get a 10% appreciation on your investment in 1 week. So it's a tremendous opportunity that we hope you guys look at, not just to be compelled to invest because of that percentage opportunity, but also that you see and you align with how we're viewing the Houston market and its potential. But that is one of the best offers that we've provided to any investor throughout the life of this platform. So hope you guys really take a look at that and talk to our investor relations team or any of us. All right, Sundance, we do some Q&A here.
Yep. First one I'll take. So Jacob asks, for example, with Miami, we've invested in 2 properties in 3 months. How many have you turned down, and what are some of the factors that make you pass on a property? Good question. So we have a waiting list of like $30 million, I think, in potential deals. Not just a waiting list, but like a lead flow, submissions for us. And really, we speak to homeowners, and we have a full underwriting guideline. So it's very similar to, maybe how you would get a mortgage. We want you to have a certain percentage of equity in the property. So you've got to have a significant amount of skin in the game, so to speak. You need to be the primary owner of your property. We just want to be no more than 30% owner in your particular property. So we have caps there and limits. So you've got to have a decent amount of equity in there. You do also have to have some credit obligations and a credit score there that makes sense for us. And you've got to have documented source of income. Not everybody has all of those things at the same time. And then you've also got to be in one of the areas that we are currently targeting right now. So we have targeted MSA. So you say Miami. So there are locations in the Miami and the surrounding Miami districts that we are looking for. If you called us from Orlando, I might not be able to assist you. Also, there are a lot of folks whose collateral, their actual home, because this is collateral based, may not meet requirements, and they may not have the equity needed to, replace the roof or fix the foundation, or lots of those requirements. So we have home inspections, we have credit reports, we have valuation models. All of those go into play and kind of create this overlay matrix to make sure that we find the sweetheart deals that we are looking for. So I think that hopefully, Jacob, that then answers your question. And then I did see one more. Ricardo, you had a similar question in that same vein, I think. Just wondering, how do these contracts work? Are they like loans? The answer is yes and no. These are 10-year contracts. These are option contracts with a buyback clause. So we are looking to purchase equity from homeowners. There is no loan. There is no interest earned. We are sharing in the appreciation upside with the homeowners. Our philosophy is, there's never been a 10-year period in time where home values have gone down. We want to share in appreciation with the homeowners. If there's, solar or home improvement, it's a win-win because the house is instantly worth more. How, generally speaking, we make money, additional money for investors is we offer to invest $100,000 in somebody's property. If their house is worth $1 million, it's just straight 10%. Well, we might say, Mr. Homeowner, really what we want is 18% of your property for that $100,000. So it's almost like a wholesale type of an operation. So we are purchasing these effectively at a discount, so that initially, right away, we have downside protection. If their house happens to go down in valuation, you, our investor, is protected. So there's no interest, but we have an oversized, we've over collateralized essentially the dollar amount that we have against that property. And so as their house appreciates, our percentage stays the same. That 18% that we've got reserved in equity there also increases. So over time, you get to share in that benefit as well. Hopefully, Jacob and Ricardo, that made sense to you. If anybody on the overall webinar wants to talk about any of the transactions or the process, or have some more questions, happy to answer those offline as well. All right, a couple of questions here about secondary markets. John or Tor, maybe one of you want to address it. Will that become available? Is that still in the roadmap? Any updates that we can provide there?
Yeah, I can start and then hand it over to Tor. I guess I do want to go one thing on the way that the pricing of the instrument works. Just to say, so if someone's getting 10% worth of cash, like Sundance just said, we are actually securing via a lien, typically 18% of the home's future value. So one of the biggest things to look at is there's tremendous upside clearly in that math. We could go deeper into it, but like the home value would have to depreciate at over 40% in total in order for that contract to really fall out of the money. So it has extreme downside protection. So I always like to add that example so someone can really think about like what is the downside risk here. I think we can all get excited about the upside, which is just tremendous. Obviously, we're talking about net asset value. Net asset value is the way that we present the share price of these funds, if you will, and that is a core element. These are growth funds. So when you think about like, well, how do I realize the value of that? It is going to be upon either the redemption or the sale of your interest, your shares. And so for some time now, we've had a partnership in place with an SEC registered alternative trading system, commonly abbreviated as an ATS, with a company called North Capital. North Capital is a registered broker dealer as well as a service provider of many services that we use. But one of the core things is their ATS secondary market platform, where current shareholders can list their shares to sell for external investors to come in and purchase. We also have a broker dealer in place to support the same, and that broker dealer is a company called Dalmore. And so we have the business relations and the infrastructure. And now that we've had some seasoning of the funds, they're still very early. We've seen some NAV movement in the early funds. We're starting to realize some of these payoffs and exits on investments. So now we are shifting to focus on building the technology to really bring this to market. And Taurus, well, I'll hand it to you.
Yeah, so as John mentioned, it's now on kind of the product and technology team to build out the platform to enable all this to happen, like they did the initial primary purchase of Cityfunds, and in the experience that all of you that have invested have enjoyed. So right now on the product roadmap, it's anticipated for late Q4 release of the secondary market, potentially early Q1, but kind of in that time frame. I think as we roll it out, just like we're diligent around NAV updates and doing it on a kind of consistent basis and getting to that consistency, we'd want to do the same thing for opening a window on kind of the secondary market. So it wouldn't be like every fund at every city fund at the same time, but allowing us to do it in a kind of concerted, transparent way for all the investors. John or Sundance, anything else to add to that? Just want to share with the kind of how the rollout would go, so people don't think you just flip the switch in a secondary.
Yeah, you got to do it in a responsible fashion.
Yes,
that's great. Yeah, there will be a lot more communication provided from us to everyone well in advance of that release, so there's understanding of how is the price movement, how is the listing process, when is the window, in all related aspects of that.
Last question, and then it is 1:47 Central Time, so we're a few minutes over, but we started a few minutes late, so we'll end accordingly. Last question is regards to maybe climate change here and insurability of Florida homes. So yes, this is a concern. Obviously, we want to make sure that homes in Florida have insurance. So part of our process is to make sure that we are added to the payees on all the insurance policies. We track the insurance policies, and in most cases, I think actually in all cases in Miami, we are in second lien position. So the primary lien holder has the optionality of putting in there what they call forced place insurance. And Citizens out in Florida is this state-run insurance agency, so we can contact them and make sure that the property is properly insured. And we do make sure that everybody has proper wind, hurricane, flood insurance. That is a requirement in order to obtain one of these liens, what we call a home share. So yes, we absolutely make sure that the property itself is insurable. And it's a nice product actually, because the insurance companies in Florida now are doing annual inspections that we get copies of. So we know on every deal in Florida annually what the current collateral condition is. So they update us and keep us sort of in the loop on the collateral condition of the property there. And the secondary markets for these, because we buy and sell equity, is moving in the right direction. And we follow the mortgage-backed securities market, which is still very, very strong in all locations. So no concerns regarding the sellability of the asset or property valuations, or you know, in general, could a storm come and hit any part of the U.S. at any point in time? Yes, unfortunately. However, insurance, is there. It is required, and so we've taken proper safeguards there to make sure that you, our investors, have invested in something that is, protected as best we can. Dion, did I miss any questions there?
Let's see. I don't believe so. I think you answered everything. We went over liquidity, talked about the Miami market, went over some more of our strategy here. So I believe we are all set. Thank you so much, Sundance and John and Tor.
Well, great. We appreciate these opportunities to share more about the performance of the fund. And as we continue to compile more feedback from everyone regarding details into the asset, environmental and economic impacts, we'll not just keep this contained here. We'll think about it. We'll do different targeted webinars and just really expand on all this to where we're available, humans talking to you guys about what this is and the opportunities it presents. Last thing I want to leave with is that anyone really interested in making a meaningful investment into either Houston or Miami, you hear Dion's voice here. Dion's our head of investor relations, and he's the perfect person to talk to about really building a plan specific for you with these funds. And I'd recommend you reach out to any of us to get in touch with them.
Great. Well, we'll wrap there. I appreciate everybody's time. Tor, John, Dion, it's great to do another one of these with you in the books. I look forward to doing another one next month.
Thank you so much.
Thank you.
Thanks, everybody.
Have a good one.